Good evening. This is Ken Long from Tortoise Capital, August 20th, 2009, with a quick look at the market health check. Let's see. Our volatility has flattened out. It's still low, so we're still in bull quiet. I've removed the red box from around the price action. It's our third day of retracements. It looks like this red dotted line is becoming tactical support. We're half the way closer to our test of 102. After 3 days in a row of being up, we've crossed back over the 20-day moving average, the green line. Next test is 102. If it breaks through there, then it's clear sailing ahead. This area in green that I've highlighted is part of the reasons to pay attention to the Williams percent R10. It moved from oversold conditions from minus 95 up to almost minus 20, where it will become overbought on a short-term basis. And so this move from oversold to overbought occurred inside this green area. You can see the oversold was triggered by that volatility move on Monday. And we've had a nice retracement from like 98 to 101, a 3% move within 4 days. Previous examples of that same oversold to overbought condition are highlighted in green also. There's this nice move. That's from 88 to 94, so that was a 6% move over 3 days. And that led, of course, to the longer period of remaining overbought, the long bull. But this is a pretty interesting indicator to help us hit turning points. And then we went from oversold here to overbought from about, looks like 89 to 93, a 4-point move in 5 days. You don't always get that follow through. Like for instance here, it went up for 2 days and then didn't get any higher. And from here it just kind of went sideways. But even so, those are reasonable and low risk entry points. So that's why we pay attention to Williams percent R. And because we trade instruments that are strongly correlated with SPY, it makes sense to pay attention to the health check. A couple other things I want to just highlight, and that is that the moving average convergence divergence histogram, mkt histogram, came below that the zero line, the signal line, and it's ticking up. You see it made a higher low, and that's considered to be spring. So if you are a believer in the 4 seasons of MACD histogram, what we would have is this period is being spring. The decline from highs to the zero line, this would be fall. And so let's highlight that one and call it yellow. This little piece where it goes from the zero line to the peak of being down, that would be winter, and then all this entire move here also from the zero line and up would be considered summer. It almost looks like a little sine wave here, and so the spring turns out to be a nice time to get in on cyclic moves. If you're a believer in MACD histogram, I like the intuitive waveform appeal of it, and so this is a good sign here for those who are looking to get in early on a resumption of a trend. So that's a quick look at the market health check, and for tomorrow, I'm very cautious about preserving profits here because we are fully valued. We're above the halfway line of Williams percent R, and so that tells us we are probably above the true value line. The test happens at 102, but if it breaks through 102, I expect it to keep going with a burst. I would look at trading QLD once more. That's the technology twice leveraged ETF, and I'm going to show you in another movie here tonight why we like that ETF. So that's the health check. and thanks for your attention.